Let's talk to Connor Campbell. He's financial analyst at Spreadex. Morning to you,
Good morning.
Connor. Right, 3 stocks that are reporting this week. Let's kick off with Moneysupermarket, the stock code MONY, down 22% in 2018.
Yeah, it's a very bad start to the year. It has to be put in some context. Like at the start of January, that you can see at the very top of the chart, that was a 2-year high for the stock. So it's pulled back, but from a fairly strong position. Although I will say, by the start of March, it was at 20-month low, so it has been quite a sharp turnaround. The main issue was its full-year figures in February. I think revenue was up 4% to just shy of 330 million, which is not too bad. However, it was dragged substantially lower by a 22% fall in revenue at its home services division. I think the main issue there was a substantially lower number of customers using the collective switch offering, which is, Moneysupermarket will switch your gas and electric to the preferred tariff. The main issue, however, was its forecast for 2018. It said that earnings should be flat for 2018 before picking up in 2019 due to sort of transitional costs of their strategy rejig. I think they're trying to optimize their website, trying to allow sort of greater customer personalization of the website, increase their mortgage price comparison offerings. A few things there that seem to be eaten into its bottom line and lead it to a fairly stagnant 2018. Obviously, investors clearly weren't very happy with that, weren't willing to wait around for this. And it's sort of left it, it's risen from those lows, and it's sort of caught between 280, 290 at the moment. So I think its first quarter figures on Wednesday are going to now should give it some semblance of direction. I think the main issue is going to be, I guess, the home services division. If you can see some improvement beyond that, if you can get its revenue decline back below the 20% mark, then perhaps investors are going to be willing to get back on board. It has, given this chart suggests the company in dire straits. It was willing to spend £40 million buying a company called Decision Tech back in March. So this is a company with money and ambition. It just seems that investors aren't particularly willing to wait the year for it to sort of pay off. However, our clients, I would say it's very mixed because it's been trading so laterally in the last month or so. Our clients are just about buying around the 280 mark. However, again, it could go either way just because of, it really depends on how willing investors are going to be to be receptive to any snippets of good news Moneysupermarket are going to offer, given that we're still fairly early on in its sort of transformation.
Understood. Okay, let's move on to Debenhams. Obviously, there's been some horrific headlines about what these numbers could net out at. Down 38% in 2018.
It does sort of feel like sink or swim time for Debenhams, really. It's the kind of stock that either could have some kind of transformation by the end of the year or just not exist by the end of the year. It's on those stocks, ditto something like Mothercare, that are really on the ropes at the moment. I think in terms of what's going on with the chart, you can see the big drop in start of January. I think that was a 14% single session decline. That was because it saw a fairly hefty revision to its full-year profit guidance. I think originally analysts had been expecting an 80 million pre-tax profit. Debenhams are now expecting somewhere between 55 and 65 million pounds. In terms of what it's going to post, its half-year figures this week, what it's going to post on Thursday, I think analysts are expecting it to halve. I think to 44 million pounds. Part of that, I think it's going to have lost 5 million just due to the beast from the east. The impact of the really bad weather in March. In terms of sales, I think for the 17 weeks to the end of December, like-for-like UK sales were down 2.6%, and they did rise over the Christmas period 1.2%. But even then, I think that was due to fairly heavy price cutting due to the weak performance of the weeks leading into Christmas. The one slight slither of hope for the company is I think that the CEO is expected to announce another sort of round of investment in trying to transform Debenhams into some kind of shopping destination beyond its retail offerings, increasing the number of restaurants in stores, increasing the number of beauty services it offers, so it goes beyond somewhere where you buy and somewhere where you spend time. But I think I maybe have been on here saying before that shopping centres exist. So to turn Debenhams into sort of a micro shopping centre within a larger shopping centre, I'm not quite sure how wise that is as a strategy going forwards. Like I said, our clients, there are obviously still sellers despite it being so low, but it's been bouncing around the 20-25p mark. We have got buyers coming in willing to take a punt on the stock heading into its half-year figures on Thursday, just because it's fallen so sharply that if investors do decide that they're willing to give it a go, it could jump quite high. But it's a risk, I would say, around those levels.
Understood. Okay, let's wrap up with Unilever, a quality stock, global name. What are your thoughts there?
Yeah, it's down 5%, but It's that's from all-time highs last October. So again, it has to be put in context of what was I think up 25%. It was still up 25% on 2017, despite falling fairly sharply from its all-time highs in the final quarter of the year. In terms of its recent figures, full-year figures were in February. I think turnover was up 2.2% if you exclude the spreads business that's now been sold on. I think underlying sales were up 3.5%, which hit the target that the company set in the aftermath of that rejected Kraft Heinz bid. I think that actually accelerated to 4.3% in the final quarter of the year as well, so there's strong figures there. I think in terms of, I think it saw underlying operating profit jump 110 basis points to 17.5%. It saw pre-tax profit up 8% to 8.1 billion euros. Very, very healthy figures. However, it sort of got caught within the wider market sell-off at the start of February. That sort of left it looking a bit sort of ropey across March into February. Oh, it's seen a jump since the end of April. I think that was due to a buy rating from UBS. Its figures this time out aren't expected to be quite as strong as they were in February. I think turnover is expected to actually drop 3.6% year on year to 12.8 billion euros, largely due to a shift in exchange rates. However, underlying sales are expected to be up 3.6% if you exclude spreads, which is again above that target set by the company in the aftermath of the Kraft Heinz bid. I think perhaps investors will want some kind of update on the Rotterdam headquarters move. Obviously, that is an issue I think that is going to be more in the spotlight towards the end of the year. I think there's going to be a vote around September time. There already talk of sort of some kind of revolt over that, and I think it'd only take 25% of investors rejecting that deal for sort of to scupper that move, and obviously that would have ramifications if they did move to Rotterdam. I think for their listing as a FTSE 100 company. So there's a lot to focus on for Unilever in the coming months. However, from our clients' perspective, they're still buying, but since it fell below the £40 mark, they've been buying the stock. Its figures are still strong. 8.1 billion euro in pre-tax profit in 2017 is an absurdly strong number.
Yeah.
I think that's given our investors confidence to be buying it at its relative lows off of the highest seen last October.
On that note, Connor, thank you very much indeed.